Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of the stock stories of the day, we've been reporting Macy's. They are disclosed that a employee may have hid as much as $154 million of delivery expenses, so they don't know what's going on with their financials. They delayed their earnings release, so a lot of issues going on at Macy's. Stocks off 3.25% today on the news. Let's check in with the analyst who follows this company, Mary Ross Gilbert, for Bloomberg Intelligence, senior equity analyst. Mary, what have you heard from the company? What's going on there? It really is an odd story.
It is an odd story and something kind of wild to wake up on a Monday morning before Thanksgiving and Black Friday. But as you know, Macy's reported that one employee had hidden 132 to 154 million of cumulative costs. But when you look at it, it's over about a 3-year period. So it's about 20 cents a share impact, meaning that they might have to restate their earnings by about 20 cents. It's not a huge number in that respect. It's huge in the sense of, well, what happened with the financial controls here? On the other hand, I think they can move past this. And I think there were some positive snippets in the press release that came out this morning with their third quarter preliminary sales results. So they reported that their comparable sales on an owned plus licensed plus marketplace basis was down 1.3% for the company. And that was a little better than what analysts were looking for. They were looking for a 1.5% decrease. And if you look at the go forward stores, so this excludes the 150 stores they're planning to close, the comp sales on that same basis were down just 0.9%. And in the third quarter, most apparel retailers have been negatively impacted by unseasonable warm weather related to in September primarily, but also in October. And so when you look at the results, we're already seeing November, Macy's reported, and we've seen this with other retailers, sales are actually performing better than what we saw in the third quarter because the weather, of course, has turned cooler. So we think those are some of the snippets of good news, including the luxury side of their business with Bloomingdale's comp sales up 3.2% and Bluemercury up 3.3%. So I think that kind of outweighs this because that employee is now gone. Mm-hmm. And of course, we'll learn more once this investigation is complete and they can report and hold their earnings call what's happened in terms of the financial controls.
Talk to me about what we know about inventory for Macy's and any discounting. I'm just asking for a friend, particularly for Bloomingdale's.
Yeah, well, of course, going into Black Friday, and the one thing that we learned from a consumer survey that we recently completed, discounts and sales, anything like that is a primary driver for sales. And the other one is weather. That comes second, is a change in weather, and that prompts apparel sales. So I think that we're already seeing pre-Black Friday sales. Macy's is always top of mind. They're known for their promotions, known for their sales. So they're already out there with their Black Friday sales going on. And of course, they're going to open early on Friday, on Black Friday. So we'll actually be there in the stores at that time.
I love that.
Yeah, absolutely. All right, Mary, thank you so much. We appreciate that. Mary Ross Gilbert, senior equity analyst covering retail for Bloomberg Intelligence. Again, a wacky story over there at Macy's. Macy's delays earnings after employee had millions in expenses. For me, it would just be, the audit and control function for the company. Can I trust the other numbers that are out there?
Right.
So that's kind of.
So how long typically do you think it takes for that to sort of clear its way out?
Well, I think what's most troubling is that it was over a multi-year period.
Yeah.
That's kind of goes to the quality of the controls, both internally of the company and then from their auditor. I'd kind of be looking at my auditor saying, dudes, I mean, this is what we pay you for, to kind of go through our statements, make sure this stuff is, in fine shape. So we'll see.
Cannot argue with Paul Sweeney on this one.
No.
Sorry, I can't do it.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get broader take on the market. Katy Kaminski, Chief Research Strategist and Portfolio Manager at AlphaSimplex, joins us. All right, Katy, this record high here, potentially another record high on the S&P. How long until we start to see re-upgrading of the S&P forecast for 2025?
I mean, this is exciting. I mean, it's a positive day. I was actually surprised. So I think, the last week or two, we've seen a little bit of retraction. And I think in general, the market is still parsing through some of the aftermath of the election. So I do think that people are forecasting, and I'm seeing more and more positive sentiment about equities, U.S. equities in particular, going into year end.
So when you woke up the day after the election, did you and your team, did you sit down and say, we got to redo our models here, we got to change some inputs? Did the market outlook materially change for you guys?
No, not at all, actually. And what's strange is that as quantitative traders or trend followers, we systematically follow where prices are moving. And I think what was the most interesting to me about the election is the Trump trade. So, for example, long equities, short fixed income, long dollar was actually playing out quite a few weeks before the election, and it just extended after the fact. It's not really working today, but it has, pretty much pre and post.
Do you think that U.S. exceptionalism, if let's call it like that, does that keep working?
Hopefully so. I mean, obviously, since that's something we're seeing in the data and we're seeing in momentum signals, but it has been an interesting month. I mean, look at this month, like the Russell ahead, US strongly ahead of EM and Europe. So that's been sort of a US centric theme this month. And you're seeing that decoupling from the US and other areas. So it does seem to have some steam so far.
And how about the US dollar here? Because that was a pillar of the Trump trade, long U.S. dollar. How do you think about that?
So the U.S. dollar, I mean, that's probably one of the bigger movers that I think a lot of investors don't realize how incredibly strong that move has been. We've had new highs on the dollar for 8 weeks. It is selling off today for various reasons related to some of the, we can talk about that later, but basically the dollar has been an overall extremely strong, especially versus the euro. I think that it's up 6.5% versus the euro in the last, 2 months, which is pretty huge.
Yeah, it was 104 we were talking about on Friday before we saw everything kind of calm down today. Okay, I keep getting notes, though, to not discount Europe. In part because the economy could get better over in Europe because the ECB is going to have to cut more aggressively, and that's going to be good for European equities, and that we can finally, I've heard this story before, can finally sort of outshine the US a little bit. Are you seeing any trends or flows or momentum into that kind of trade?
So I agree with that, but I also think that has two sides. If the ECB keeps cutting, that's going to put more pressure on the euro, which is not going to be helpful. The one story that we will be looking for that we haven't seen so far is perhaps stronger growth at some point in Europe. So there will be potential for that rotation if we can see stronger growth. I think the euro trade is still a little bit more questionable because of what I said, that if ECB continues to cut through next year and we see a more steady Fed, that's actually going to be pro-dollar. So I think it's going to require quite a bit, especially with the weaker euro.
Are you concerned about inflation here at the U.S. economy, or do you feel like the Fed's got that under control? Because I feel like I'm hearing more and more people say, boy, 2025, that might be a thing in terms of resurging inflation.
So we definitely do see cross-asset themes and movements to show some indication of concern for inflation. I think initially post-election, there was a lot of concern. Today is a day where you're seeing some of that abate because given some of the, the choice of U.S. Treasury Secretary by the incoming president suggests that, there's a little bit more pro-business, and recent commentary has also focused on maybe tariffs won't be as aggressive. So I think the general digesting of that information is about figuring out how much inflation could we actually have as a result of a change in policy? There's definitely still a good chance that that's something on the longer term, especially with the deficit as high as it is.
This might be a really dumb question, but does better U.S. economic growth then mean more inflation? In that, yeah, no, I mean just that. Like, in order to small caps and mid caps to really work, in order for value to really work, you really need a stronger U.S. economy. But then that comes with demand, and then you add tariffs into that, and then that leads to higher prices.
Yes, and I think that's part of the narrative that people are concerned about is if we do have, that coupled with high debt or high deficit, then at some point you have to have higher prices, which is kind of what happened post-COVID, which is why people, especially us, we think a lot about what's going to happen to the yield curve, because that's probably where you're going to see those price expectations for inflation baked in. It is interesting to see also how much gold has gone up this year, because that tends to be a play on inflation. So I think there are definitely enough people out there that have significant concerns about inflation longer term and the potential impact of that.
Katy, thank you so much for joining us. Always appreciate getting a few minutes of your time. Katy Kaminski, Chief Research Strategist and Portfolio Manager at AlphaSimplex up there in Cambridge, Mass.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. And because I love energy, we talk a lot about energy. We'll just throw that in there too. Why not? So one company that you may not have heard of is called Bloom Energy. They are a fuel cell maker. They made a lot of headlines in the last couple weeks and hit an all-time high on November 22nd after it made a deal with American Electric Power. American Electric Power is going to use their fuel cells to bring electricity to, say, hyperscalers. AEP is going to use up to 1 gigawatt of Bloom's fuel cells. Now, something that's quite interesting in this is that a lot of companies in the energy space do cool stuff, but syncing up with the companies that could actually use their cool stuff isn't always easy. In fact, it is quite difficult. So we wanted to get an idea of how this came about. K.R. Sridhar is CEO of Bloom Energy, and he joins us now from Silicon Valley in California. K.R., how did this deal come about?
So we have been working with data centers for a very long time now. We have over 300 megawatts in multiple data centers across the country. These are the smaller data centers called the edge data centers that are located where customers are, somewhere in the 5 to 10 megawatt range in a particular site. So we have transacted close to 300 megawatts. So we are a known player to data centers. Now with the hyperscalers, what's the difference? It's a much larger data centers. These are now particularly more important in terms of growth because of AI and the amount of power they need. And currently, these hyperscalers, as they are growing very fast, the transmission distribution is not able to keep up with providing those hundreds of megawatts of power right at the site where you need it within the time that you need it. Maybe 5 to 6 years, they may be able to provide the power, but the data center really wants it today. They want it now. So we are a perfect solution under those circumstances because our Bloom Energy servers can be deployed in a matter of months right where the customer is, thereby not worrying about the transmission distribution gridlock and providing that reliable, clean, always-on power to the data center. So that's the reason this happened. And here what happened is the electricity provider, AEP, said, we don't make nuclear power plants, we don't make gas turbines, we don't make fuel cells. We're agnostic, we'll buy your systems. And similar to us using those other power sources to provide power to the customer, here we can take your fuel cells and take the power you produce and give it to the data center. However, the big advantage here is we can put these fuel cells right where the data center is, thereby avoiding the transmission distribution issue.
So, Kara, I mean, just, I didn't know much about your company before, so just reading up here, it's like right company, right place, at the right time, with the right technology, and boom. Talk to us about how good your fuel cells are. How would I know whether your fuel cell is better, more productive than, say, a competitor?
That's a great question. So let me go away from fuel cells just into electricity for the customer. At the end of the day, we all provide a service or a product to our end customer. That electricity that a data center takes has to be clean. It has to be always on and reliable 24/7. It needs to have a pay-as-you-grow characteristic, and it needs to be future-proofed in terms of sustainability. Bloom Energy is one of those solutions that offer all of the above, no ors. It's the genius of and. So we are the most efficient way of taking natural gas and making electricity out of it without combustion. Because we don't combust, there is no NOx, SOx, particulates, anything going into the atmosphere. So there is no local air pollution. And if you look at our system, they're like Lego blocks. You put many of these Lego blocks, hundreds of them, to be able to provide power to a data center. If any one of them has to be serviced, you can just hot swap them in and out. So the reliability and the resiliency of our systems are very high. And and you can pay as you grow. Data centers, even though they build a big data center, don't start that entire data center on day one. They may do 1/3 of the load, and then a few months later, they may add additional load. As they're adding the load, they can add more and more of our fuel cells. You can't do that with a gas turbine. You can't do that with a nuclear power plant. So we bring all these attributes in. So I would say we are ideally suited for this AI data center market.
Oh, now the financial terms were not disclosed. I appreciate that. So I'm going to ask about the money a different way. How easy was it or difficult was it to come to an agreement on price with AEP?
In this particular case, it was fairly easy to come to that agreement. Nothing is easy, but relatively speaking. And here is why. There are 3 parties involved. Actually 4. The data center customer, AEP, the public at large where this is being installed, and Bloom Energy. We were able to put together a win-win-win-win for all 4 of these stakeholders. Why is that? Number one, let's start with the public at large. With other kind of provisions that were being contemplated, the fear of the ratepayer was because the hyperscaler is going to get a large amount of power from the transmission distribution company, they will end up carrying the bill. In this construct, AEP made sure none of the costs associated with putting these fuel cells and providing that clean power to the data center will cost the ratepayer any money. So that was a win for the ratepayer. Number 2, for the data center. For the data center, the price of not having power on time is significantly greater than the cost of power. If you just think about the race in AI and who has to get there competitively, so time to power was the key metric, and they would pay a slight premium to be able to get that, and that penciled out. For AEP, they were able to grow their customer base, give them their growth needs without disintermediating them and having them go to some other state, which is what has been happening in places like Virginia, where data centers are moving away from there because there is not enough power. So it was a win for AEP in retaining their customer and taking care of their customer and making money. For Bloom, whether we are in front of the meter or behind the meter, it is the same thing. Whether we sell it to AEP, who then provides the power for the data center, or we sell to the data center and they provide it and they take their own power. For us, we are agnostic because we get to make the sale and we get the gross margins on the product. So that's how it was constructed.
Alix, another story I missed. Bloom Energy, stock's up 72% year to date, all-time high today, up 92% on a trailing 12-month basis. Where were you? Where was this story for me like $50 ago?
Yeah, sorry, man. Missed that one for you.
Yeah.
My bad. All right, great to see you. Thank you so much for the great story. KR Sridhar, CEO of Bloom Energy, and just sort of the idea that how you pair all these things together, whether you're an energy provider and then electricity provider and then a hyperscaler, and getting all of that to match up sounds like it could be really simple, and sometimes it is, as KR was saying, and sometimes it's really not.
It isn't, but it sounds like, again, they have a great product for this part of, the AI energy provision kind of scenario. Wow, good stuff.
As you said, right time, right place.
And again, in San Jose, California, I mean, just the amount of innovation in all parts of the industry in that part of the country is just amazing.
Yeah.
Fortunately, my youngest goes to college there, so I'm like, dude, get a job.
You're like, just feel the
take it all in.
innovation. Get the innovation.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, and we're streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. Part of the Trump trade was to sell bonds, and the market certainly did. We had rates shoot up. We got a little bit of a pullback today, as Charlie was pointing out. But let's see what's happening in the world of fixed income today. To do that, we check in with RJ Gallo, Senior Portfolio Manager over at the Fixed Income Group at Federated Hermes. They're in the great city of Pittsburgh, PA. RJ, when you and your team woke up the day after Election Day, you sat down, you got to your next strategy meeting with your fixed income folks. Did you guys change your outlook at all, or maybe how you approach the market?
Yeah, we did. I know plenty of people didn't want to bet on the election, and I would put us in that camp. I would say that the sharp increase in yields from mid-September all the way up pretty much to Election Day in part reflected that the betting markets had moved sharply in Trump's favor. And so the market was advancing to start pricing in a Trump trade even before the election outcome was known. We were a little cautious on duration during that period. Probably booked a few basis points of excess return as a result. We didn't make a big bet, a little bit. For the actual election itself, the polls were close. The betting markets weren't. As it turned out, the betting markets were much more accurate. And then following the election, we also got a little short duration, thinking that we would maybe test 450 on the 10-year. And that's exactly what happened. But as we look this morning, we're back to 430 pretty much.
So, So what does that mean then for the long end? Is it path of least resistance lower, or do we stay sticky?
I think that this is sort of a tactical retracement. I think that the move to 450 was pricing in as much as one could. The idea of the Trump trade, a broader fiscal deficit, stimulative suite of policies, especially deregulation, and the prospect of tariffs and trade war, which could boost inflation in the short run. That's what drove rates in part to where they were. I think the fact that we've had a retracement, the market was sort of consolidating as we wait to see how all these policy plans actually get implemented. How successful will the Trump administration be in implementing them? How open to negotiation are they on tariffs? The fact that the market's responding with a bit of a rally today, yields sharply lower, about almost 10, 11 basis points on the 10-year. It seems that the market views Bessent as a pretty conventional pick. I think I would agree with that. I wouldn't say it eliminates the Trump trade. It's just the next iteration of the unfolding of the actual Trump outcome, which is going to take time to see.
So let's talk about this U.S. economy here, and how do you think that'll be reflected in the rates market? It seems some of the economic – now, this is going to be a busy week for economic data, inflation data, jobs data in terms of claims. Your thought on the economy and how that might be affecting this Federal Reserve?
The economy has held up remarkably well. The once expected recession a year ago never showed up. The economy had a lot of tailwinds. Credit markets have done well. The recipe for outperformance in fixed income has been to own lower quality credit risk over higher quality credit risk. I'm glad to say broad fixed income indices of all sorts have generated positive returns. The economic outlook from here is still relatively supportive. I worry a little bit that the overall suite of Trump policies that I've described previously might actually end up being stimulative in the short run, but at a meaningful cost in the longer run, in the sense that you'll have larger deficits, more debt, and the bond market might be left to be the source of discipline in terms of reacting to that outcome with higher yields as we go into further into 2025. But a lot remains to be seen. We have to see how serious is the Trump administration about the broader tariff threat. Mm-hmm. Is it in fact a negotiation? I do think that the Fed's, the lesser expectations for Fed easing are in fact rational, as the fiscal policy expansion is pushing in the other direction in terms of monetary policy expectations.
So fiscal policy to expand and the Fed gets looser.
No. The Fed gets less loose. The
Less
Fed,
loose, but they're still loose.
yeah,
They're just less
if
loose.
you look at the SOFR futures, for example, they gapped sharply higher in implied rate in terms of the terminal rate in this trough upon the election outcome, really. As the market was moving to price in the Trump trade, less Fed easing was expected. That is very rational. Less monetary stimulus as the fiscal side opens up more with bigger deficits.
The best performance by far in fixed income this year, RJ, has been high yield and leverage loans in the U.S. So I guess the market's comfortable with risk, I guess.
Well, I think once it became clear that the economy had significant tailwinds and corporate profits have held up relatively well, it's been sort of risk on in terms of where you put your capital up and down the credit quality spectrum. And spreads have tightened, and you've generated very, very favorable returns. To be frank, in our multi-sector strategy here at Federated, we've been a little more cautious, thinking that spreads had gotten too tight. As a result, we've been a little underweight. Fortunately, we've been able to make it up a little bit more on curve positioning. The yield curve has steepened sharply, and a number of our strategies, taking an active position to benefit from that, has really worked very well. We've also been overweight mortgages, which have generated incremental outperformance, not as much as high yield corporates. But there's a lot of arrows in the quiver of a fixed income manager, and we've been shooting some of them in the right direction. The high yield one has been a little tough, and the rally has outpaced us. We're still a little cautious that might actually crack as we head into next year, especially if rates start to rise in a sort of bond vigilante theme around the Trump administration.
All right, RJ, super appreciate it. Have a great week. RJ Gallo, Senior Portfolio Manager, Fixed Income at Federated Hermes.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We have a great story out in the Bloomberg terminal that talks about their new head of wealth, Andy Sigg, and how he's revamping the wealth business and how that's going, basically, at the end of the day. Joining us now for more, Katherine Doherty, Bloomberg Finance Reporter, joining us on that story. So how is it going? So the story kind of goes in different directions on that exact answer.
Right. I mean, Andy is 1 year into his new role, and he came into it with a lot of difficulties, and the basic infrastructure that Citi was working with in their wealth division was something that had been lagging peers. It was way behind in terms of speed, execution, and really that was something that Andy had focused on right when he came in. And upgrading the technology was one thing, then bringing talent was kind of the second pillar to improving the wealth division. And keeping talent is the hardest part about building a wealth business across Wall Street, because it's a very competitive business. The pay is oftentimes used as a way to lure experienced advisors to competitors. And so not only are you trying to focus on keeping that talent, the talent is tied to the assets that they're managing for their clients. So anytime you lose some big advisors with millions or even billions in assets, that's going to affect your business moving forward. So Andy had a very big agenda in front of him in terms of having to clean up, and not just clean up, but then improve Citi's wealth business so that it could truly compete with the big peers on Wall Street.
Yeah, because like when I think of Morgan Stanley, I think of wealth management. And that's different. When I grew up in the business, I thought about them as sales and trading and investment banking. Citi, I don't necessarily think of wealth as a kind of a growth driver for them, but I know in their private bank, which generates $2.3 billion of revenue, it is high-touch service for the wealthiest clients, including a quarter of the world's billionaires, minimum net worth $25 million. So is this a situation for Citi that Jane Fraser has to just put a flag in the ground and say, this is a core business for Citi and we will invest accordingly?
Private bank is definitely one of their money makers. You can see that in the numbers.
Yep.
But also, if you think 2 tiers down, you have Citi Gold. And this is clients with average monthly balances of at least $200,000. So it's definitely not at the private bank tier. The private bank tier, why they're trying to keep that part of the wealth business up is because that's where the biggest assets are. That's where the revenue really gets generated when you have the wealthiest. And it's not just Americans, it's oftentimes billionaires in Asia. They're really focused on growing their business outside of the US, which is different from some of the other big Wall Street banks that are more US focused in terms of building up their own private bank assets. And so Citi, their private bank, I would say, was their strong suit and continues to be their strong suit, but it doesn't mean that that's going to stay that way. So they really have to remain competitive, keep their advisors that are catering to the wealthiest individuals, not just in the US, but across the globe.
Did they lose advisors because they were poached or because they let them go? Because they were revamping it under Andy Sick?
So it's a combination. Just last week, we reported that 2 of Citi's former private bank advisors defected to go to Bank of America, actually, in their private bank, which is interesting because that's where Andy Sick had come. He worked in the Merrill division, but still, it's under the Bank of America umbrella. And those 2 advisors, they brought $7 billion of assets that they manage. So that was a big kick to Citi. And so when you see that, but it's not, I would say, unique just to Citi. There's stories like that all the time of some of these really big advisors bringing their team to a competitor, and oftentimes they're just looking for it's opportunity, and most of the time that opportunity is translated in pay and in compensation.
Another risk to the talent is something that Alix and I work with Commonwealth people, those platforms that are non-wirehouse investment banks. They say, hey, why are you working for Merrill Lynch or where you have to sell their products? Go on your own. We'll support you with all the technology, all the back office stuff, and you go run your business like you want to run your business. And that is also another risk to all these big wirehouses. So great story. Not surprisingly, it's the second most read story on the entire Bloomberg terminal. So when you talk about our terminal users and their businesses and their futures,
there you go.
They read it.
Oh yeah.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Happy Monday, everybody. I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from our Interactive Broker Studio right here in Midtown Manhattan. You can also check us out on YouTube as well. We also, at around this time every Monday, we tap our wonderful Bloomberg BNEF folks. They do amazing research on commodities, power, transport, industry, buildings, ag sectors, all in the terms of helping businesses and finances transition to green energy, to the energy transition. They cover great stuff for us. Anna Davies is a Bloomberg BNEF's head of renewable fuels, and she joins us now. Anna's worn many hats also over at BNEF over time. Anna, what kind of renewable fuel projects are there, let's just say in the U.S., and let's set the stage, because then we want to know what's going to look like 4 years from now.
Sure. So there's a good number of projects in the U.S. Nice to be here. And there's a wide range. The U.S. is the biggest market at the moment. So a lot of the projects are based here. A lot of renewable fuels. When we talk about renewable fuels, we're really talking about basically biofuels at the moment, made from oils like soybean oil or even used cooking oil, like the excess grease from your fryer. The key here is that unlike ethanol or biodiesel or biofuels you usually think about, renewable fuels are a special term for ones that are drop-in ready, which means they produce a diesel molecule or a jet fuel molecule that's basically the same as fossil diesel or jet fuel. So you could just blend it one for one into your diesel or jet fuel pool. There's no blending limit. It can just go in however much you have. So it's really cool in that regard. A lot of the projects in the U.S. Are based, especially out of California. You could take an old oil refinery and convert that to produce a bio oil, like a bio feedstock instead of a crude feedstock. So that's really common. There's also a lot of projects being developed to use other feedstocks, things like corn ethanol. Because if you think about passenger vehicle fleet going electric, you're going to have less demand for gasoline or ethanol. So this could be another use for that ethanol in the world today.
Got to ask the question everybody wants to ask: how will the Trump administration impact renewable fuel business?
That is the million-dollar question, probably for every clean energy sector. I'd say that renewable fuels, compared to a lot of the other sectors of clean energy, might be a bit better insulated than most because This is a sector where it really promotes the agriculture industry by using biofuels as a new demand source. It also is a way for the oil industry to get a second life because they can take this old refinery and convert it into something new. So in that regard, I don't think it's going to be completely in the crosshairs. There are ways, though, that the Trump administration might have a big impact on this sector. One of the big ones is if he puts a tariff on used cooking oil from China or some of the feedstock
We import
imports.
used cooking oil from China.
We do. China produces a lot of used cooking oil, a lot of fried food. They export the cooking oil to California, which they can then blend into these refineries. Used cooking oil is a really popular feedstock for renewable fuels because it has a low carbon intensity. Otherwise, it's just wasted. Right, you throw it out. It has to be collected.
What
you have to be
did we
disposed
do
of.
before this with our used cooking oil?
It was collected into and dumped in probably a dump.
But so we don't have enough used cooking oil here in the U.S. to supplement.
Don't
we fry everything?
Yes. We have a lot, but if you think about replacing, the diesel or the jet fuel pool, you can always use more.
I see. So to that point, what is the price spread between renewable fuels and traditional fuels right now?
It's high. Renewable fuels. Their cheapest are probably 2 to 4 times, which is a big range, but more expensive, than fossil like jet fuel. And if you talk about some of the novel technologies, so one of the ways to make these renewable fuels is to take carbon dioxide and green hydrogen, which is great because then you're not using any biofeedstock. That could be up to like 10 times as expensive as jet fuel. These are pricey fuels, and they're probably not going to get too much cheaper because a lot of it is just the technology needed.
So... But if, as an airline, am I mandated to use a certain percentage of clean fuel?
Depends where you are. In Europe, starting next year, yes, you are mandated to blend it in. In the US, we don't have mandates yet. The biggest is we're doing a lot of carrot incentives. So the Inflation Reduction Act has a tax credit for producing renewable sustainable aviation fuel. That would give a discount of about $1.25 to these producers. It's not enough to bridge that cost. It could bring it down closer, but it doesn't.
And then if that goes away, then it makes it even worse. So what's the best way to lower that gap? Is it we need better technology, we need scalable technology, or more sourcing?
I don't think technology is going to come down too much in cost because a lot of the cost, technology is a big component, but the feedstock is a big component too. And it's hard to get
that cooking
cheaper.
oil from China.
Exactly. So that could make it worse. A lot of it is probably going to be a mix of mandates and subsidies. So if you have a mandate saying you just have to blend a certain amount, that's going to cause, maybe you put a premium on the cost of jet fuel, a tax on jet fuel, that can cause that price gap to close. Or if you offer an incentive to produce these fuels, that can bring it down. There's a lot of research being done on new feedstocks, like something like cover crops. If you have a field, you could just plant a new oil crop in the off season. That can help retain the soil. You can use the same land. You don't have to have this issue of food versus fuel land use. But that's the $1 million question: is how cheap can you get it?
So interesting.
It is. I'm glad we do this every week.
Yeah, see, we learn stuff. All right, Anna Davies, thank you very much. Really appreciate it. No easy solutions is basically at the end of the day what we see. Anna Davies is Bloomberg BNEF's head of renewable fuels. Here's something that caught my eye, Paul. Did you see this one? That some colleges are cutting their tuition by 50%. As Ivy's near 100,000. Did you see this?
No.
So, So basically you got some private colleges like Bethel University in Minnesota, for example, cuts its tuition price from $44,000 to $26,000 in an effort to attract more students because other ones are just so expensive. But then can you survive if you slash your tuitions?
Right. And small colleges that do not have an endowment, the answer probably is no, because they fund so much of their total funding comes from tuition. They don't get income off the endowment like bigger schools do.
Yeah.
So that's why they've always had a very stretched business model. But having been involved in higher education for a long time at the board level, you got to cut your costs dramatically, and there's no will to do that anywhere.
You got to cut costs, you got to cut tuition, you got to enroll more students, and you also got to spend to attract the best.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.